Well, hello and welcome to this evening's webinar, AAII and Better Investing, Tools and Tactics for Dividend Investors. Thank you so much for joining us. We're happy to have you all here. And my name is Jenna Brashear, and I'll be your host for tonight. A few things to go over before we begin. I do want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And we have two wonderful speakers tonight, Charles Rotblut from AAII and Doug Gerlach from Better Investing. And I want to thank both of them for being here with us this evening. And be sure to keep an eye on the chat throughout the webinar, as we'll be sharing some helpful resources, key insights, and other links and resources. And if you have any questions for our speakers during the presentation, please submit them using the question section of your GoToWebinar control panel. Once our presentation concludes, I'll select a few for Charles and Doug to answer. And if your question isn't selected during the broadcast, feel free to email us at members@AAII.com. And if you experience any issues with the audio or video of the webinar, please consult the GoToWebinar website for support at gotowebinar.com. Just a friendly reminder that this presentation is recorded and a replay of the webinar will be sent to all who attended today. The recording will also be accessible at AAII.com/webinars. In this presentation, Charles and Doug will cover a few things, such as how to identify high quality dividend paying stocks using AAII's 9 dividend focused screens, key criteria for selecting dividend stocks with growth potential and reasonable valuations based on AAII's dividend investing strategy, and how Better Investing's GARP method and SSG Plus tools help evaluate dividend yield, payout history, and income contribution. We love that our webinars are interactive, so after our presentation, we'll host a live Q&A, including 2 special promos from AAII and Better Investing, so please make sure to stay for the entire broadcast. And with that, I'd like to hand over the presentation to Charles to kick us off.
Thanks, Jenna. Thanks, Doug. Pleasure to be with you. Thanks to everyone who's here tonight. I'm going to start. We're going to talk today. First of all, I will start about how to find and analyze attractive dividend stocks. And I'll also touch on ETFs as well at the very end, but the big focus is trying to explain to you what characteristics of dividend paying stocks you should pay attention to find the winning dividend stocks, because we obviously want winning dividend stocks and not losing dividend stocks. So as a bit of a background, I'm the editor and one of the co-creators of our dividend investing newsletter. The DI model portfolio, which accompanies the newsletter, holds 24 dividend paying and dividend growing stocks. The yield is 2.6% on the portfolio. I will get to the yield more in a moment, but I first want to discuss what the current yield environment is, and then I'll go over some of the traits and characteristics we use in our dividend investing portfolio, as well as show you some good resources on AAII.com you can use to find dividend paying stocks, as well as where you can go look for dividend ETFs in addition. So first, let's talk about the market's yield. And I know everyone really loves a nice, big, juicy yield. But as you can see here on this chart, you have 2 lines here. That lower line is the iShares Dow Jones US ETF, IYY. It holds about 1,000 of the largest stocks. The upper green line is our dividend investing portfolio, and I have yields plotted since 2012 when we started the DI portfolio. One thing that's notable is that since 2012, so about over the last 13 or so years, yields for the market have largely remained below 2%. The sole exception was that very short-lived COVID bear market where yields jumped up. And so even now, it's still possible to get attractive stocks with yields above 1.1%, and I'll show you, you should be careful when reaching for yield. So while a yield of say 4% or 5% might seem really enticing, you want to tread carefully. You want to ask yourself, what perceived risk or what perceived complexities are priced into that stock and causing that yield to be so high. You might find a bargain or a gem in the rough, but you can also find a stock that you really don't want to get so much involved in. And the one thing I do want to point out that even though yields overall have been low and they're still low, there are still many stocks trading at attractive dividends, attractive yields with attractive levels of cash flow. And you do not have to look solely at blue chip stocks. Many people tend to associate dividend-paying stocks as being your blue chip large cap stocks, and that is not the case. It may surprise some of you, but nearly 2/3 of the S&P mid-cap 400 pays dividends. And there are many small cap stocks that pay dividends as well. You can also find dividends across sectors. Our dividend investing portfolio currently holds stocks from 9 different sectors, including industrials and technology. So if you've solely been looking in places like healthcare or energy or utilities, expand your focus. You'll find dividend stocks across the universe of stocks in terms of sectors and in terms of market capitalization size. Now, here's a sampling of some of the dividend-focused screens we have on AAII.com. We have 9 screens that specifically look for dividend-paying stocks. Now, on this chart on the right side, you'll see letters on here. The V that you see in this stands for value, meaning the screens have a valuation component. They're looking for stocks with lower valuations, more attractive valuations. The I that's located near the right-hand side, that stands for an industry focus. So for instance, when you look there at the Graham defensive non-utility screen, it's not only looking for value, it's looking for yield and quality, but it's also it's screening for stocks that are not in the utility sector. Versus, we don't have it on there. We do have a Graham defensive utility screen, which is it's right there at the top. You see the I there as well. That's actually looking solely for utility stocks. And utility stocks have slightly different criteria because of how they're regulated. They actually tend to have higher payout ratios because what they can charge if they are a regulated utilities actually governed usually by governmental sectors or usually some type of public utility board that's governing the rates. Now, also some of our dividend screens are based on our famous investors such as Benjamin Graham and Geraldine Weiss. And overall, when you look at our 50 AAII stock screens, you will see some that are quantitatively based and some that are based on famous investors. Our quantitatively based screens focus really on criteria. For instance, we look at the dogs of the Dow. Those screens are looking for the highest yielding stocks in the Dow Jones Industrial Average. I do want to focus on Geraldine Weiss. For those of you who are not familiar with Geraldine, she was known as the Grand Dame of Dividends. She ran a dividend investing newsletter for years. She actually signed off as G. Weiss. And for years, people did not know she was a woman until one day she actually showed up on Louis Rickhauser's stock hour, showed up in a blazer and skirt, and a lot of mouths dropped when they found out this very successful investor. And keep in mind, this is the 1960s. They found out that she actually was a woman, but a very successful investor at that. And guys, I hate to tell you this, but when studies look at gender, women do tend to be better investors than us guys do. So we just have to be a little bit better and kind of up our game to compete with them. But going back to dividends, with Geraldine Weiss, she used yield as a valuation tool. She believed that when a stock's yield got a little too high, and you can see this here on that upper green line, investors would recognize the stock as being a bargain and buy shares. And the key thing to remember is that yield is inverse to valuation. So the higher the yield gets, the lower the valuation is. Whereas if you look at PE, the lower the PE is, the more attractive the valuation is. So yield is inverse. Higher yields means a lower valuation, a more attractive valuation. Now, when yields fell too low, as you can see here on this red line, that means a stock is overvalued. And Weiss believed that investors would view the stock as being too expensive and sell the stock. Now, those of you who use technical analysis might recognize this chart as showing a channel. It's a similar theory to the price channel, where you're looking to buy the stock at the bottom of the channel and sell at the top of the channel. This is inverting it to where you're looking to buy the stock when its yield is at the top of the channel and sell the stock when its yield is at the bottom of the stock. And Weiss believed it was like a pendulum, that if a stock's yield got too high, it would eventually swing back to being too low. And she observed there's actually a time component to this. On average, Weiss believed it took a stock about 3 years to go from being undervalued to being overvalued. And once the stock became overvalued, it would take about 2 years for that stock to go from being overvalued to being undervalued. So if you're a dividend investor, you can actually use this and actually realize long-term gains from selling your stock. And so allow you to capture stock, allow you to capture price appreciation, allow you to capture income, and also pay long-term capital gains if you're holding the stock in a taxable account. Now, we, in our dividend investing strategy, we follow Weiss's strategy. We actually look to buy stocks when their yield is below their 5-year average, and we look to sell stocks when their yield rises above that 5-year average. But the other component, Weiss also did consider dividend growth. And dividend growth is the other key component you want to seek in a dividend-paying stock. This chart here is based on data from Ned Davis and Hartford funds. Companies that initiate or raise their dividend tend to be the top performers. Companies that cut or suspend their dividends, well, let's just say you should hold on to your wallet tightly and run fast. And here's why. If you look at this chart here, companies that have initiated or grown their dividends since 1973 have turned $100 into nearly $16,000. That's a massive amount of wealth creation. Now, what if you bought in stock? What if you bought in stocks that just didn't pay their dividends? Some of these tend to be growth-oriented stocks. Well, as you can see here, down here in this line, moving my mouse over so hopefully you can see it, those companies have turned $100 in 1973 to about $900 in 2024. Still nice growth, but a really small amount when you consider the amount that dividend growers have delivered in terms of capital appreciation and return. And those dividend cutters, they've turned $100 in 1973 to $63 in 2024. In other words, over the last 50 years, they've cost you 37% of your original investment. And when you factor in inflation, that is a massive loss of purchasing power. So when I talk about running away from dividend cutters, I really mean it. Those stocks as a group will really cost you in terms of opportunity costs and absolute dollars. You don't want to hold on to those stocks. You really want to focus on those dividend growers and the stocks that are initiating their dividends. And these two screens that are available to all AI members seek out stocks with dividend growth traits. With Weiss, she sought out stocks that have raised their dividends at least 3 times over the last 7 years. Our high relative dividend yield screen is a quantitative screen. it seeks out stocks that have raised their dividend over each of the last 6 years. So Weiss was more of a value investor that also wanted growth in addition to it. Our high relative dividend yield portfolio is really a growth and value screen. You can almost think of it as a growth at a reasonable price screen for dividend paying stocks. It's seeking stocks that have grown their dividend by at least 3% over the last 7 years on an annualized dividend growth rate, but also they've raised their dividends each of the last 6 years. And we like stocks that actually grow their dividends and have attractive valuation, because when there's a history of the company growing its dividend, it tells you that management has a commitment to growing its dividend and the company has a fundamental strength to grow its dividend. So here are the traits. So let me go over some of the traits that we actually desire in our dividend investing portfolio. We want growth and cash flow from operations over the last 12 months. The reason why is that cash from operating activities is what pays the dividend and what funds growth. A lot of people use profits and earnings per share are a very commonly used indicator of fundamental strength, but earnings are an accounting figure. Cash from operating activities is how much cash flow is a company generating from normal business activities, or how much cash is it using up. And you want that number to be consistently positive, because that's what funds the operations, what pays for marketing, and what pays for salaries. It's what pays your dividend and funds your buybacks. We also want returns on assets above the sector median. We look at return on assets because it tells us how efficient is the company at using its assets. Is the company becoming more profitable relative to its assets, or is the company becoming more bloated, which could cause problems for profitability in the future? I also look at the dividend growth rate. I want to know that the company's committed to growing its dividend. And I want to know that the company is actually growing its dividend, having that trend. And I personally not only look to see if there's dividend growth, but I also look at the magnitude of growth. On a percentage basis, is it staying steady? Is the company actually growing its dividend at a stronger rate? Or if we see the percentage change in dividend growth slowing, is it still at a high level? Or do I see temporary factors occurring where the dividend growth perhaps has historically slowed relative to its historical growth, but there's a temporary issue with the business that's likely to be fixed within the next year or two, creating an attractive valuation entry point for the stock. So you always want to do that fundamental analysis when you're looking at a dividend stock, and not just by buying on yield alone. Now, for a dividend investing portfolio, we have what's known as 3 dividend pillars: valuation, growth, and strength. And we score stocks by grades. We use grades. We actually use percentage rankings for each stock from 0 to 100. We assign grades. And these grades are just like the grades you got in school. A's will make your parents happy. F's will get you that really mad look and have you grounded for weeks on end. Same thing with stocks. We want stocks that are A's. And if a stock's grade falls to F, we're giving it the boot. We don't want it in our portfolio. And so at a simple level here, when you look at our valuation grade, we're looking for stocks that have attractive valuations. So the yields are above that 5-year average. Ideally, they're growing their cash flow and have reasonable earnings, growth in earnings, which falls into our dividend growth score. And then for our dividend strength score, we want to see the company has fundamental strength. So what you see here are the grades for oil producer EOG Resources. And if shareholders should be happy because the rates on grades across all 3 categories. So they got attractive valuation, it's been growing its dividend, and it has strong fundamentals to grow and maintain that dividend. So here are the components behind our dividend strength grades, because I've talked a little bit about value, I've talked a little bit about growth. We look at the earnings payout ratio. We want to make sure that the company's payout ratio is below the sector mean. And the reason why we look at sector means is that the payout ratio varies by industry. So what's a low payout ratio for one company may not be low for another industry. For instance, I mentioned utilities beforehand. They have very high payout ratios, whereas financials, for instance, have much lower payout ratios. So it's always important to consider those ratios relative to a sector, since they do vary by sector and industry. Now, we also look at liabilities to total assets. We want those to generally be lower as well. They do vary again by sector, but they also sometimes vary by company, but we do want them to be lower because lower debt levels give a company more flexibility in terms of what it can do with its cash. Also, the higher the debt level gets, the more at risk the company is at hitting its upper debt covenants. And if those debt covenants get hit, you have to remember bondholders come ahead of shareholders, and those bondholders can cross their arms and say, you're not paying that dividend anymore. So you want to make sure that does not happen. We look at times interest earned. That's basically how many times earnings is interest, what percentage of earnings does interest cover? And again, the higher this ratio is, the less flexibility a company has. And we want to look at the sector median because, again, debt levels vary by sector. And finally, has a company sustained its dividend? We look at least over the last 7 years. We'll look longer. We want to see the company not only has a commitment to growing its dividend, but it hasn't cut its dividend at some point in the last 7 years. We don't go back to the financial crisis because we did see a lot of companies either cut or suspend their dividend during the global financial crisis of 2007 and 2009 because things got so bad. But we want to look over the recent history of the last 7 years. Has the company have a good record of maintaining and growing its dividend? And I want to go back to this idea of why you should avoid high yields. So this is looking at our quality dividend grade. And our dividend grades are percentile ranked. So we rank each stock from 0 to 100. We assign a percentage rank on how it compares to all other stocks in the dividend universe. And what I'll tell you here is that while the extra income from a yield may seem really appealing, you want to tread carefully because, again, it's a sign that investors perceive higher levels of risk. And so it creates really a paradox. As a dividend investor, you really want that big, juicy yield, but they might also represent the riskiest opportunities. And so we can see the relationship in this chart. The green bar over here, and I'm moving my mouse over here, so hopefully you can see it right there on the left side. Those are the stocks with the strongest dividend strength scores. As you can see, they have the lowest yields, 1.2%. And as the grades get worse from B to C to D to F, look at what happens with yield. They rise. So while the stocks with grade A have a yield of 1.2%, the median for the stock with grades of F is 4.3%. Those yields are rising because investors are pricing in growing levels of risk. When we look for a stock to add to dividend investing, we look for grades of A or B. We're not looking for perfect stocks. As a value investors in general, you don't necessarily need perfect stocks. You need stocks that are mispriced. So if a stock has some dents, some dings, some scratches on a door, that's okay as long as the stock itself is priced attractively and it's fundamentally strong, meaning, the car may not have the most attractive appearance to it, but if you start the car, it gets great gas mileage, accelerates well, the radio works, always a key component of the car, and it's priced right, that can be an attractive investment for you. The same thing in stocks, dividend-paying stocks. If it's got strong growth in its dividend yield, it's fundamentally strong, and it yields attractive, it makes it a good stock, especially if it's priced at the right price. So let me switch real quick to ETFs before I hand off to Doug. For those of you who are interested in dividend-paying ETFs instead of stocks, you'll find them in our dividend ETF guide. Our ETF guide. And the way you find dividend stocks, not just in our ETF guide in general, is you want to look in a value category. we use Morningstar's category, and Morningstar does not have a dividend category. But what we've noticed is that they do tend to be in the value realm. So in our screener, you can actually call the large cap stocks, mid cap stocks, small cap stocks in our dividend guide. And in each of those, look at large cap value and then sort for yield. And look for this funds with the higher yields tend to be your dividend components. And here's one thing I want to point out here. You notice that I have two stocks check marked. In our ETF guide and our mutual fund guide, if you check those check boxes, it actually gives you the chance to do side-by-side comparisons, a hidden gem in our ETF guide. So here's an example, and I have two ETFs right here. You're seeing the iShares Select Dividend Yield, the iShares Select Dividend ETF, and the Schwab US Dividend Equity ETF. I actually chose two of those because they're on the last screenshot, so nothing magic about those. But one of the things I want to point out to you is that the Schwab US Dividend Equity ETF has a slightly lower yield of 3.81% versus 3.87% for the other Schwab fund, but it's outperformed. So the returns are a little bit higher. And even though its yield was lower, but it's actually been accompanied by some of its difference has actually been accompanied by higher volatility. As you see near the bottom, the risk score. So the risk score for the better performing ETF, which is the iShares Select Dividend ETF. The reason why that is because it has higher volatility. So a risk score basically looks at the performance for all funds within a given category, all funds across the universe. One is the benchmark, means the average volatility. Higher scores mean more volatility. So you did get higher volatility, but you also got a little bit more price volatility. So better performance, slightly lower yield, more volatility. So there is always a trade-off going on here. But the one thing I do want to point out to you is you never want to pick a ETF by name alone. You always want to make sure you have a dividend stock. So the reason I want to go back here, if you look at the top fund on this chart here, you'll notice it says real assets. This is a ETF that actually invests in commodities. So just as the case with books, you never want to judge an ETF by its cover. You actually, in this case, you do not want to judge an ETF by its name. You actually want to see what the ETF invests in. And even if an ETF has similar sounding names, it can have a very different strategy. So what I encourage you to do, and this doesn't just apply to dividend-focused ETFs, it applies to dividend ETFs, to all ETFs, all mutual funds, and even closed-end fund. Know what it does. Go to the fund family's website and look at the fact sheet, look at the prospectus. And one thing I'll tell you with ETFs in general, here's another quick hidden gem before I hand it off to Doug. Anytime you see an index fund tracking index, you can take that index name, put it into your favorite search browser, Chrome, Edge, whatever it is, type in that index name, say the S&P 500, and then type the word methodology. That'll usually help what the methodology is. You can actually see what the index is investing in or how the index is designed. And again, just because two indexes sound similar, they can be very different, and that could lead to very different funds that you're investing in. So just keep that in mind. A little quick aside. Jen, I'll hand it back to you so you can give it back to Doug so we can get back on the topic of dividends.
Well, good evening, everyone. I am Doug Gerlach from Better Investing, and we're going to talk about our approach to dividend investing, particularly as it relates to stocks, which is our bread and butter at Better Investing. Better Investing is a nonprofit investor education organization. You may know us as supporters of investment clubs, but we also provide tools for individual investors and a stock analysis methodology called the Stock Selection Guide. This is, of course, our disclaimer. This is an educational presentation, and we always advise you to do your own research before you make any investing decision. I'm going to pick up where Charles left off and talk a little bit more about the history of of yields as they relate to stocks in the market, and why chasing yields may not be the most productive strategy for most investors. A little bit of background: our subsidiary equity research service, part of our iClub Central for-profit subsidiary, publishes 3 investing newsletters. I'm the editor-in-chief of all 3 of these. The Investor Advisory Service is our flagship stock newsletter. It was established in 1973, so it has a very robust track record of outperforming the market during bull and bear cycles. It's been named to the Holbert Investment Newsletter Honor Roll for 15 consecutive years, more than any other newsletter in the US for its consistent long-term performance. The second newsletter we publish is the Small Cap Informer that was founded in 2013. So we have more than a dozen years of track record for that publication, outperforming the S&P Small Cap 600 Index. And then in 2023, we launched the Dividend Informer, using a new approach to long-term investing, using quality and dividend growth metrics to reduce volatility and still deliver a performance that's acceptable for individual investors. And as part of that, we spun off some of the stocks we had been tracking in the Investor Advisory Service over to the Dividend Informer. Now we track about 50 different companies in the Dividend Informer. We do not offer a model portfolio, but serve more as a research service for self-directed individual investors. We track around 70 or 80 stocks in the Investor Advisory Service, small, mid, and large cap, and focus primarily on around 40 smaller companies in the Small Cap Informer. So this gives us a little bit of a sense of what we're all about and how we came to our dividend newsletter strategy. Trying to answer that question: does dividend investing, as it is traditionally known, still valid here in 2025? Traditionally, dividends have been part of a lot of different investing strategies. Charles outlined a couple of those, but a lot of the thinking, the conventional wisdom that governs dividend investing may be slightly outmoded due to shifts in the markets and business practices over time. And so we really have come to believe that if you want to invest for dividends, you should ensure that the companies that you're investing in have a sturdy growth component. That is, the capital appreciation needs to be part of the formula in order to deliver the returns that you're probably seeking. If we look at this graph of the yield of the S&P 500 going back to 1870, we'll talk a little bit about the history, because I think it's really emblematic of shifts in thinking and shifts of analytical approaches to dividends. The classic dividend approach, a value-oriented approach to individual stocks, really originated after the 1929 crash, when some of the brightest academic minds said, well, we got to figure this out, because things were pretty crazy when the market crashed. In the aftermath, isn't there a way that we can identify which stocks are going to perform better? And so, Graham and Dodd and Fisher and a lot of other academicians and financiers went to work and came up with some of the rules that have drifted through the decades and informed a lot of individual investors' approaches today. In the late 30s, 40s, and into the 50s, as you see illustrated on the graph here, yields were 4 to 8%, and dividends were a major part of the total return of most investors' portfolios. You could really invest in dividend-paying stocks and earn a return that would outpace inflation, that would outpace the GDP growth, that would perhaps deliver a little extra return in capital appreciation and satisfy the needs of many investors. In the 1960s, the so-called go-go years, when technology and innovation really started to be embraced by American businesses. We had all sorts of technological innovations like the Polaroid camera or the Xerox machine, and we sent a man to the moon, and there wasn't anything that Americans couldn't do. And these new innovations required a lot of capital, and so yields, as you see on the graph here, fell to as low as 3%. In many cases, much lower than the 2 decades prior. As we went into the 1990s, we had another period of economic expansion, coupled with rising appreciation of stocks and tech stocks in particular. This whole new dot-com era had arrived, and these new companies were very popular, and they weren't paying dividends. They needed their capital to grow their businesses. And so, as you can see here, yields continued to fall as a function of the appreciation of share prices, as well as company policies regarding dividends. And then as we arrive into the last 2 decades, certainly lower interest rates and shifts in federal policy really helped boost stock prices faster than the growth of dividend and reducing that equity risk premium. Yields in this period of last 20 years have rarely exceeded 2% and have in fact fallen this year to what is pretty much an all-time low yield for the broad market of around 1.2%. And so this is certainly giving a lot of traditional dividend investors pause, trying to navigate what is going on with yields and dividends right now. Certainly, we are in an era where boards of directors and company managers are embracing what you might call more conservative dividend policies, but really it's a preference for how they're using their capital. Companies would rather now use their cash in ways that are easier to halt or increase than paying dividends. Because of course, a company that cuts its dividends is often viewed pretty negatively. And so instead of initiating that dividend or perhaps raising the dividend by a significant amount, they will push through marginal increases in dividends and use capital instead to buy back shares, which has the function of increasing earnings per share. And you'll see this quite frequently with board authorizations being announced in company earnings releases as the boards contribute more capital towards repurchasing shares, both as a signal to other investors that they believe their share price is undervalued, but also as a use of capital that if they authorize and they don't carry through with all those purchases, nobody seems to pay any mind to that. And alternatively, if they were to increase the dividend, then they would be beholden at that new rate, and that would reduce their options for using cash in the future. Certainly, debt repayment is also part of that. Again, something we hadn't seen in a good chunk of the last 2 decades with rates being so low, but companies now, as their interest rates have climbed back up again, looking to reduce their cost of capital or reduce the interest expenses, and so might be using their excess cash to repay debt. And we view that as a positive. That's a good move. It's very shareholder friendly to reduce your borrowings and reduce your interest expenses over time. All this combined has contributed to payout rates declining significantly. The payout rate, of course, is the percentage of companies' earnings that's paid out as a dividend. The average payout ratio of the S&P 500 has dropped from around 56% over the last 100 or so years down to 36% today. So that's a pretty significant drop, and I think that's a good harbinger of where yields and dividends are headed in the current corporate era. So this new approach to dividend investing that we've embraced in our Dividend Informer newsletter focuses on total return, not just yield, but in dividends plus capital appreciation. And we believe that this, using a sounder strategy to dive beyond the yields into company fundamentals and capital usage is really key to a strategy that looks to benefit from corporate dividends. You can't simply go out now and just buy any old high yielding stock. As Charles pointed out, often those highest yielding equities are the ones that have the most risk embedded in them. There's something flawed with the company, so they have a reduced potential to grow their dividends perhaps, and dividend cuts may be on the horizon. So we have criteria that we've established and that we utilize in our newsletter for criteria. I'm going to talk about these, and we'll give you some example companies that fit the bill using the scoring system that we utilize in the newsletter. We look at 4 key categories for companies that are considered to be covered in the newsletter. These are capital return, growth, stability, and governance. And we score them all on an A, B, C, or D scale. Very rarely will a company that scores D in any of these categories be included. And needless to say, if they fail completely, they're not in the running whatsoever. So here are some example companies. I'll show you some fundamental graphs that come from our Better Investing SSG Plus Stock Selection Guide Plus application. But these are, it's interesting, as Charles mentioned, that you rarely find a perfect company that scores across the board at the top level in all of the categories, and we've definitely found that to be the case as well. So we never see, have yet to find a perfect straight A company in our coverage. So a mixture of A's, B's, and C's can often be a recipe for finding opportunities and good values in these types of companies. So the first category is capital return. It's really assessing the company's shareholder friendliness through their use of dividends, share buybacks, and share offerings. Because after all, if a company is issuing more shares, if they're capital intensive and they're issuing more shares and generating dilution of their earnings, that's not always in the best interest of shareholders. But certainly, how is the company, what are their policies regarding the payment of dividends, regarding the growth of the dividend, and are they increasing it regularly over time? Are they buying back shares? Are the number of shares outstanding declining over time? Or they, and often it's the case that companies will be buying back shares, but the result is a net zero change in the number of shares because they're issuing options on the other hand. So they're merely buying back shares to cover those employee options, for instance. So you need to really understand, and this is how our long-term graphs often come into play. So 2 of the stocks that score highest in this area are AbbVie, the medical supplier, and you can see the graph here of shares outstanding and the dividends per share. So obviously we're seeing dividend growth. That's what we look to see. And we're seeing some general downtrends in shares outstanding. Of course, when you look at a 10-year history like this, there will always be cases, as with AbbVie, where more shares were issued for particular purchases, for acquisitions or other purposes. And so you will see that that does not disqualify the company as long as we understand it and we see a stable number of shares outstanding for the last 4 or 5 years, and so that to us equates, doesn't shift our opinion in this area for that company. And then the Hershey Corporation, also you can see a distinct downtrend in shares outstanding while dividends are increasing. That to us says this is a company that is focused on shareholder-friendly practices when it comes to capital return. The second category is growth. Our primary stock selection guide methodology that we use in Better Investing is primarily growth focused, but we also believe that growth of sales and earnings is required in a dividend strategy. Because without that growth of sales and earnings, companies are not likely going to be able to increase their dividends. And we think that dividends should be growing as a way to reward investors over time. So primarily we'll look at sales, pre-tax profit, and earnings per share. We'll also focus on cash flow. We'll talk about that a little bit later. So we like it when companies are growing. They're growing. Consistency is valued, it's not required. In this case, we see Abbott Labs on the left, revenues, pre-tax profits, and earnings per share trending upward over the last decade. On the right is a smaller company, so they're not all large cap blue chips. This is Carrot Packaging, and again, you see the revenues increasing, you see the pre-tax profits increasing, you see the earnings per share. Increasing down below. Occasionally you'll see some dips, but over the longer term, you will definitely see that. We will not see, we're not going to see companies growing or seeing their growth stall. They're not going to be growing at the same rate that you might require or demand for a pure growth investing strategy. But we do like to see, a particular level of growth, typically not much below 7 or 8% on an annualized basis. Our third category is stability. One of the objectives of our dividend investing strategy is to reduce portfolio volatility. And we do that by seeking out companies with consistent growth of sales and earnings per share, or in the case of real estate investment trust, funds from operations per share, as well as free cash flow. And so consistency to us is a measure of company quality. Because a management team that's able to grow its business, to grow its sales and earnings and free cash flow over time at a fairly consistent rate means that there's a plan in place, that they have a business plan that they are executing against, that they're not opportunistic purely, they're can be taking advantage of any opportunities that come along, but they're not trying to chase fads. They're really trying to build a business over the long term. And to us, consistency of past growth can really give us a sense that the management team is functioning well. So here are a couple of real estate investment trusts. Again, these are the names that you haven't heard of in that smaller, mid-sized to smaller company area. And again, because these are real estate investment trusts, the blue graph here is funds from operations per share. Typically in our analysis, that's adjusted funds from operations per share, but you also see free cash flow as well as revenues. And kind of typical of real estate investment trusts, you'll see the revenues growing at one particular rate and funds from operations growing at a reduced rate. But you can definitely see the consistency here. Phillips Edison is a younger company, so not as much history, but again, the trends are all heading in the right direction, and we like to see that those straight lines moving up and straight, and in many cases parallel when you're looking at operating companies, with REITs being the exception to that. And then our fourth criteria is governance, evaluating the management and the board's alignment with shareholders and their capital allocation practices. Often the proof is in the pudding. If you look at corporate governance, the answer to is the company's management and board doing a good job at being aligned with shareholders comes out in their results. But we can certainly look at their policies about share issuance and repurchasing, the dividend payments, and how they are handling debt. So here we have Nexstar Media on the left, and you can see that distinct downtrend in shares outstanding while dividends are increasing and debt is being paid down over the last half decade. On the right is Honeywell, so a much larger business there, but also shares declining, dividends increasing, total debt had been at a manageable level, has increased in the last year due to some discrete acquisition activity that the company undertook. We're not going to ding them based on that increase. We believe management still has a good handle on their cost of capital, their balance sheet, and so we're going to give them the benefit of the doubt that they know what they're doing with the borrowing they've got, that they will take advantage of opportunities to refinance, to reduce the debt load, and manage the interest coverage, so they don't get disqualified for that, but they still remain part of our coverage universe. So hopefully those companies are good examples, a mixture of names with which you're probably familiar, as well as some companies about whom you have not heard before. Our approach, we position it as a strategy for investors who perhaps have been using a growth total return strategy for many years, perhaps many decades, have been satisfied with the results, but as they reach the later stages of their investing life cycle, are ready to ease up on the throttle. It may not be desirable to simply sell your stock portfolio and buy ETFs, or switch into bonds, or modify your approach, but perhaps if you're comfortable holding individual stocks, then you can simply start to replace some of the companies in your portfolio that don't serve that desire for perhaps some lower volatility, and still delivering capital appreciation, but without the objective of perhaps outperforming the entire market. So the trade-off is you give up a little bit of return for an approach that has a little bit lower volatility. The average beta of the companies in our universe is about 1.1. So slightly more than the broader market, but nowhere near the excesses of the Magnificent Seven, or the mega cap tech darlings of today's market. And so for us, this is a strategy that many investors should be considering if they're worried about volatility, if they're worried about risk. We think that this is a style that is, kind of falls between the cracks between the pure dividend yield chasing and the pure growth investing, total return growth at a reasonable price style of individual stocks. We recognize this approach may not outperform broad market averages, but if we do deliver lower volatility, then we will have achieved our goals. So a couple of takeaway thoughts. We think that chasing high yields purely for yield's sake is a flawed strategy, that if you want to be successful when investing in dividends, you can focus on total return. So with a hefty portion of that return being driven by dividends, but also be mindful of the ability of the underlying companies to grow their businesses. Those four areas, capital return, growth, stability, and governance, are easily analyzed. You can use our stock selection guide tool. You can use any number of screeners. A simple read through of a company's financial statements can often give you a sense of how well companies are working in those areas. And hopefully at the end of the day, you'll benefit from the reduced volatility. So we'll turn it over now for questions, Jenna. Thank you all for turning out. You can follow our Dividend Informer for free. We do publish it on Substack. So without becoming a full subscriber, if you find the Dividend Informer there, you can sign up, get the occasional posting, the commentary picks, the monthly recaps, and when you're ready, you can unlock the full research and all the company selections. We've got a promo code for Better Investing members and one for AAII members to get you the maximum savings there.
Excellent. Thank you so much, both to Charles and Doug for your presentations. Yeah, we got a lot of great questions coming in. So let's take a look. I think the first question, let's see. First question is talking about raising dividends. So what is it considered a good percentage for a company to raise dividends year over year?
I'll give an answer. Charles, you can refute or agree. In part, this is something of a loaded question because it's going to vary by size of company. It's going to vary by industry that the company is in. As Charles mentioned, utilities, real estate investment trusts, and business development companies. These are companies that are going to be delivering higher yields, higher payout ratios. They're paying out more of their capital, and they're going to, though their shareholders are going to be expecting dividends to be increased on a fairly regular basis, and so that will be part of it. I, I often when I do screens on dividend paying stocks, especially, I am not looking for them to grow their dividends faster than they're growing their earnings per share or their free cash flow, because again, if a company pays out more than it earns over time, that's not sustainable. So I like to kind of peg the growth rate of dividends to the growth rate of typically earnings per share, and that will give you a good ballpark for the growth of the earnings, which is a proxy roughly for the capital appreciation, the increase in the share price that you can expect, plus the dividend yield to get you your target total return.
Yeah, I agree with what Doug said. Two other things. One, as the general benchmark, the growth should be above the rate of inflation. Otherwise, if it's not, and you have a high yield, but the dividend's growing slower than the growth of inflation, you're basically losing purchasing power with your dividends. The other thing is, right, you have to look at the industry itself, but if you're following some companies, including companies that say maybe a dividend aristocrat, look at how much they're raising their dividends. We sell this AT&T. It's a stock we first held when we launched the dividend investing portfolio. We actually ended up selling it because every year it was raising its dividend 1 cent per quarter per year, which meant every year its dividend growth rate got slower and slower and slower. So technically it was an aristocrat because it had raised its dividend for so many years. And it was still raising its dividends, but it was doing the bare minimum. And AT&T eventually had stopped growing their dividends altogether. So that's the other benchmark I would use. But otherwise, for those of you who are expecting a debate here, sorry to disappoint you, but I agree with Doug on what he said.
Excellent. Those are both great answers. We got a couple questions coming in regarding, if a company suddenly stops paying dividends, is that automatically a signal that positions, companies should be liquidated?
In general, yes, unless there's something that's just, and at least from our standpoint, yes, unless there's something just very unusual going on either in macro environment, the global financial crisis, or if it's a situation, perhaps there's something special going on in the company where maybe they're doing a spinoff or they're doing a big merger where it's clearly temporary and the management's made it clear that's a temporary occurrence. Those are very rare. I'd say probably at 95% of the time, we're going to kick the stock out unless there's something like a massive event going on, such as the global financial crisis.
Yeah, I would just add that during the early stages of the pandemic in 2020, a number of companies suspended their dividend, and I think that was often, for many of those companies, it was more caution than they ended up requiring. But given what was known at the time, for many of those companies, you can't argue with management's decision to figure out how, what was going on in their businesses, and there were, a lot of companies were stockpiling cash. A lot of companies were exercising their credit lines, so we wouldn't. I don't think we would necessarily downgrade a stock in that situation. But otherwise, and there will always be those companies that cut the dividend, reformulate their business, figure it out, and then start paying the dividend again or start increasing it again. But those are those are the exceptions, and I wouldn't I would be very cautious anytime a company cuts or pauses its dividends. And this is different. This is very U.S. centric, and around the world in other countries, dividends are often variable, and we have seen a number of companies. I think an increasing number of companies, it's still very small in the US, that are adopting a variable dividend strategy, which means that if they make a lot of money in a quarter, they'll pay more of a dividend. If they have lower earnings in a quarter, they will pay a lower dividend. And because of that variable dividend strategy, the market understands it and doesn't ding them for not paying out a consistent full amount. That's still pretty uncommon, and in those cases, the analysis, the fundamental analysis, looking at the growth of earnings and revenues to measure the consistency of growth, can be a very useful tool to help you sort of know what the expected dividend might be given the company's history.
Excellent. And we also got a couple questions coming in regarding signs or indicators that may suggest the company is about to cut their dividend. So obviously, when a company cuts their dividend, the price drops dramatically. Is there some red flags that investors should be aware of ahead of that cut?
I'll go first. I'm a big cash flow person. Cash flow is the lifeblood of the company. You start seeing negative cash flow, and keep in mind, cash flow from operations can be negative for a given quarter, even a given year, just solely because of timing issues. Say, for instance, a company needs to load up on its inventory right before the end of the quarter. That could cause cash flow from operations to be negative. But you start seeing it be consistently negative, particularly with falling or negative earnings. That's usually a sign as well. But typically, you start seeing other signs too that are just says that the business is in trouble. You start seeing slowing sales. You might see inventory turnover get slower. You might see margins collapsing. So usually it's rare that it just comes out of the blue. Usually there's signs that business is deteriorating before they get to that point.
If you have a crystal ball, that's always useful. A 100% accurate projection tool to tell you how likely a company is to continue to maintain its dividend. Otherwise, again, kind of circling back to our core approach at Better Investing in the Investor Advisory Service newsletter and across our dividend newsletter and small cap newsletter, we focus on quality companies. So we eliminate those companies that are that I would argue are more likely to be in that situation where they can't sustain a dividend. They don't even crop up in our universe because of that underlying base of fundamental strength and quality that we demand.
That makes sense.
Yeah, I was pointing out, I mean, if you look at what Doug talked about, we talked about with dividend investing, you see a lot of similarities, and we're both, I think, focused on fundamental strength in both things. And when you focus on fundamentally strong companies, you're not guaranteed to eliminate all the really bad companies, but you increase your odds. And a lot of investing is just simply getting the odds in your favor. If you do that and you're disciplined, you're about 80% of the way there.
I agree. And let's see. Okay, so we have some questions. Obviously, I think people they're comparing and contrasting different assets. And what are your thoughts on including higher yield REITs or things like covered call ETFs?
Doug, do you want to go first?
Well, we are stocks. We're all about stocks. But real estate investment trusts, I'm personally a big fan of them. We cover them in all three of our newsletters. We cover some real estate investment trusts. I think they're a great diversification element that any individual investor can utilize in their portfolio. And so, you know, and just the caveat, they're a little trickier to analyze. You need to be able to understand funds from operations per share and adjusted funds from operations in order to analyze those stocks. But in our tools, we simply substitute FFO, EPS, FFO for EPS. So we show throughout the stock selection guide, we show funds from operations per share wherever you would have used earnings per share. So it makes it pretty easy to compare and contrast amongst the different companies. Beyond that, we don't get into the weeds with arcane strategies and options and calls. We like to keep it simple. I think that, you know, that's the minimum. We certainly have many members and subscribers who use our research as the fundamental foundation for their stock selection, but then they'll layer on any options and call strategies on top of it. They'll use technicals to time their entries and exits, but it's not something that we recommend necessarily or say that you have to do this. So that's our approach. We're kind of ambivalent about that aspect of it.
For dividend investing, we actually like to keep the portfolio very tax friendly. So we don't hold REITs, we don't hold master limited partnerships, we don't hold business development corporations. And that's not to say there aren't some attractive investments in those sectors or those groups. We just want to keep the portfolio friendly from a U.S. tax standpoint. That said, I do have about 20% of my 403b, which is similar to a 401k, invested in Vanguard's REIT fund. So I personally do hold them. They do add diversification. Their correlations relative to stocks have varied, and they've kind of risen more in the late past several years, but they are a source of income. As Doug said, you do need to use a slightly different metric and really focus on that funds from operations just because of how they're structured from a corporate standpoint.
Excellent. Well, thank you. And I think that's all the questions we have time for today. I don't want to go too long because I want to be respectful of everyone's time, but I do want to give both Doug and Charles a moment to, have a few minutes for some closing thoughts. So Doug, do you want to kind of kick us off?
Yeah, I see someone commented that this seems like an ultra low volatility approach, and maybe you're giving up some yields that you might be able to generate. And yeah, I think that's absolutely the case. That's the whole point, is that whenever you're talking about risk and volatility, individual investors are really terrible at evaluating their own risk tolerance. The emotion gets in the way. When you ask investors how risk tolerant they are, they say, "Oh, I can handle lots of risk. I'm in it for the long term. I'll be happy to sit when the market's tanking." But in reality, they get nervous. They take action. They respond emotionally, and so having a strategy that's specifically designed to provide less of that market gyrations over time and lower volatility is really the point. And again, if it's not for you, it's not for you. There are hundreds and hundreds of strategies that you can use to invest in the market. And then I would also just point out that as Charles mentioned, that companies of different sizes and they look outside of the traditional industries, and that's very much the case. And I think there's a case to be made for small cap stock dividend investing as well. We cover some REITs and other dividend payers in our small cap newsletter, and it's interesting because you don't get those the Geraldine Weiss style swings in yields in the smaller cap because there's so much less demand for those particular kinds of smaller companies, that it gives you some opportunities there to earn some yields coupled with capital appreciation. So that would be something to talk about. Next month, I think we're going to talk about small cap stocks in this webinar series. So maybe we can touch on that aspect of it in September.
Yeah, so follow up. And one thing, those of us whole presentation saw Doug and I both talking about quantitative measures, and and actually having, guidelines we use. And I think that's probably one of the biggest keys. And it doesn't just tie into dividend investing, but it really is about letting the numbers drive your decisions. And it's very easy to get attached to a stock. Maybe you have a friend that talks up a stock, or maybe you have a friend that follows a different strategy. And a really key part of investing is simply discipline. And when you have a strategy that's routine and you keep following it, and DI, we have rules, we have our grades. Doug talked about with his product, they actually have numbers they follow as well, a ranking system. That type of stuff keeps you disciplined. When you follow those and you let the numbers tell you when a stock is attractive, when a stock needs to be partnered with, if you keep following that over and over and over, you're actually going to get higher returns. And then the nice thing is, if you let the numbers drive your decision, you often get steered to stocks that perhaps you haven't heard of that are great investments that really will drive your portfolio. And speaking from personal experience, I've been working in the investing field for over 25 years. I have the gray hair to show for it, but I've never been able to predict the stock in my portfolio is going to perform the best. And I can tell you from personal experience, it's typically the stock I didn't expect. And it's not always the flashiest stock either. So when you let the numbers drive your decisions, I think you'll find out that it boosts your returns, leads you to great stocks you might not have considered. And at the end of the day, you'll have greater wealth. And if you're a dividend investor, long-term, you'll have a more consistent and better income flow as well.
Excellent. Well, thank you so much, both of you. I want to first, thank you for your time and for your fantastic presentations. I want to reiterate, if you have questions about AAII's tools or services, feel free to email us at members@AAII.com, or you can give us a call at 312-676-4307. That's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. If you have specific dividend investing questions, you actually can email Charles directly at charles@AAII.com. And then if you have questions for Better Investing, please direct your questions to service@betterinvesting.org, or you can call them at 877-275-6242. And then you can see on the screen that Doug has put his email address as well, gerlach@aiiclub.com. So if you'd like to reach out to either of them with questions that we weren't able to address during the broadcast, feel free to do so. Now, I really appreciate everyone for sticking with us, and I wanted to kind of reiterate some of our two exclusive attendee offers. I put a lot of good information in the chat, but I wanted to verbally say it. You'll also get an email later on this week that also will talk about this as well. But for new subscribers, can try AAII Dividend Investing for just $2 for 30 days, where you'll get access to our model portfolio, dividend stock ideas list, tools like the DI grader, screener, and you'll get weekly emails for an entire month to try it out. Plus, you'll get access to member benefits like the AAII Journal, investor guides, stock screens, and a lot more. So you can visit AAII.com/betterinvesting. And then Better Investing is also extending a special offer to AAII members on their Dividend Informer newsletter. So you can visit dividendinformer.substack.com/AAII to sign up. And then I also put in Better Investing has another promo. I included that in the chat as well for AAII members. So you can visit that website, betterinvesting.org/AAII, and read up on those as well. And then both offers are listed as handouts in the handout section of your GoToWebinar control panel. And then, like I mentioned, will also be included in our follow-up email that'll go out later this week. Our next partnered webinar that Doug spoke about will take place on September 23rd at 7:30 p.m. Central, where we will cover small caps, a topic on which both AAII and Better Investing both offer extensive resources. More information will be sent out closer to the date. And lastly, this presentation was recorded and a replay will be available at AAII.com/webinars later this week. Webinar attendees will receive an email with the link and other resources in the next few days. And with that, we wish all of you viewing good health, good fortune, and a great rest of your evening. Thank you so much and take care.
Good night.